Welcome to the deep dive. Today, we're cutting through the hype and diving headfirst into a topic that's really reshaping things, the big surge in crypto adoption we're seeing in 2025.
That's right. This isn't just some, niche tech thing anymore. We're going to unpack the data, the shifts, and really what it all means for you, whether you're already deep in or just starting to peek under the hood.
Yeah, exactly. So our mission today is to pull out the key insights. We've looked at a whole stack of sources reports from security.org, EY Parthenon and Coinbase, JP Morgan, Cointelegraph, The Daily Upside, the Atlantic Council, and more.
It's a lot of info.
It is. We want to highlight the real-world impacts, see who the major players are, understand the benefits, and figure out how you can actually prepare for this changing financial world. Hopefully a few aha moments along the way.
Let's get into it.
Okay, so the big question first. Just how many people are actually dipping their toes into crypto now? We hear mainstream, but what are the real numbers?
Well, the numbers are pretty striking, actually. As of early 2025, we're looking at about 28% of American adults. That's around 65 million people owning crypto.
Wow, 28%.
Yeah, and that's nearly double what we saw back in late 2021. And globally, it's even bigger. Over 824 million people own some kind of digital asset, with well over 560 million identified as crypto owners worldwide back in 2024. It's definitely not niche anymore.
That's a huge jump, and it sounds like it's not slowing down. I saw something like 14% of people who don't own crypto plan to buy this year.
That's right. And even more telling, something like 67%, two-thirds of current owners plan to buy more in 2025. The momentum is definitely there.
So what are they buying? Is it still all about Bitcoin?
Bitcoin is absolutely still the king. Our sources show 74% of current owners hold it, and 66% planning to buy want Bitcoin.
Cool.
But Ethereum is a very strong second, owned by nearly half, 49%, and targeted by 43% of future buyers. And maybe a bit surprising, Dogecoin is up there too.
Really? Doge.
Right. Yep. 31% own it, 24% plan to buy. So it shows people are getting comfortable looking beyond, just the top two.
That is interesting. And what about who is investing? Is the picture changing there? Are we seeing different demographics getting involved?
There are definitely shifts. I mean, historically, it leaned heavily male, right? Around 67% men to 33% women among owners.
Right.
But we're seeing more women entering the space. About 13% of women aged 26 to 45 now own Bitcoin, which is significant. And the median age is 45.
So older millennials, younger Gen X.
Exactly. That group seems to be really driving a lot of the current adoption wave.
Okay, but here's where I think it gets really interesting. It's not just individuals anymore, is it? The big players, the institutions, they seem to be jumping in.
Oh, absolutely. That's maybe the biggest shift. We're seeing a fundamental rethink in institutional asset allocation.
How so?
Well, a recent EY Parthenon and Coinbase survey found that 86% of the institutional investors they talked to either already have crypto exposure or plan to allocate to it in 2025.
86%, that's huge.
It is. And 85% increased their crypto holdings in 2024 with similar plans for this year. And get this, 59% plan to put over 5% of their total assets under management into digital assets in 2025.
Wow, 5% might not sound like much, but for huge funds, that's serious capital.
Exactly. Especially U.S. investors and hedge funds, they indicated even higher allocations. It's moving from like a fringe bet to a real part of the portfolio for many.
So what's the why behind that? Are they just chasing the high returns we sometimes see, or is there more to it?
It's a mix. Potential for higher returns than other asset classes is definitely the top reason. 59% said that.
Makes sense.
But almost half, 49%, also see it as investing in innovative technology. They believe in the underlying potential. Nearly 80% expect prices to go up, and almost 70% see crypto as, the biggest opportunity for good risk-adjusted returns over the next few years.
So it's performance and potential. And I guess the rise of ETFs, these exchange-traded products, has made it way easier for them to get involved.
Precisely. That's been a game changer. About 60% of institutions prefer to get their exposure through regulated things like ETPs. It fits their existing frameworks.
We saw the big Bitcoin ETF approvals in early 2024.
Right, January 2024. And they took off. BlackRock's iShares Bitcoin Trust, it holds nearly $75 billion alone.
Incredible.
Then Ethereum ETFs followed mid-year. And now analysts are saying there's like a 95% chance we'll see spot ETFs for Solana, XRP, and Litecoin approved in the second half of this year, 2025.
So the floodgates are kind of opening for institutional money via these familiar wrappers.
That's a good way to put it. It just lowers the barrier significantly.
Okay, so we've got individuals piling in, institutions making serious allocations. What are the real catalysts pushing this forward? Let's dig into some of the drivers. Maybe start with the political side and this quest for regulatory clarity. There's been talk of a Trump effect.
Yeah, the political angle is definitely part of the conversation, according to the sources we looked at. We need to be clear. We're just reporting what the sources say here, not taking sides.
Right, absolutely. Impartial view.
So a security.org report suggested that 60% of adults who know about crypto think its value will go up under a Trump presidency, and 46% think he'd boost mainstream adoption.
Why is that?
Well, it seems fueled by some rhetoric and potential policy ideas mentioned, like setting up a national strategic Bitcoin reserve or stopping government sales of seized Bitcoin. There's also been talk about appointing figures known to be pro-crypto, like David Sachs, into advisory roles, maybe an AI and crypto czar.
Interesting perception. And how do the institutional folks see the political climate impacting things, especially that regulatory clarity everyone wants?
They're definitely watching it closely. U.S. institutional investors largely expect more investor interest, at 60% and more investment from financial firms at 59% post-election.
Okay.
And crucially, 47% expect regulatory clarity in the near term. And that clarity piece, it's seen as the #1 catalyst for growth by 57% of institutions.
So clear rules are paramount.
Absolutely. And we are seeing some movement, like the SEC proposing a faster 75-day timeline for crypto ETF approvals. That's way quicker than the old 19b4 process. It signals, maybe a more streamlined approach is coming.
Okay, so politics and regulation are big factors, but there's another, maybe more surprising catalyst bringing millions of people in: gaming.
Yes. Web3 gaming. It's acting like a massive sort of Trojan horse for crypto adoption.
How does that work?
It fundamentally changes the relationship between the player and the game. You're not just playing anymore, you become a stakeholder. Think about games like Upland.
The virtual real estate one?
Exactly. You buy, sell, trade virtual properties as NFTs, non-fungible tokens. These aren't just points in a game. They're unique digital assets you own, potentially with real-world value. Players can actually monetize their time.
So you own your in-game stuff and can potentially earn from it. What about this DePIN concept I've heard about? Decentralized physical infrastructure.
Right, DePIN. That's another layer. It uses blockchain to basically incentivize people to build and run real-world infrastructure, like computing power or internet connectivity.
Okay. How does that apply to gaming?
Well, take Tashi Gaming. It uses player devices, like a mesh network, to create peer-to-peer gaming zones. So games can actually run without relying solely on centralized servers. Your idle computer could be helping power the game network.
Huh. So the players themselves become part of the infrastructure?
Kinda, yeah. It blurs the lines and lets players potentially profit from the networks they use. It's pretty clever.
But for gamers to adopt this, it needs to be seamless, right? They probably don't want to deal with complicated crypto stuff.
Absolutely critical. And that's where tech like Immutable comes in. It's an Ethereum Layer 2 solution.
Meaning?
Meaning it sits on top of Ethereum and makes transactions super fast and basically free, zero gas fees. So the blockchain stuff happens under the hood. It's invisible to the user. Games like Gods Unchained use this. It feels like a regular slick card game, but the ownership is real.
Removes the friction. Got it. And are we seeing like really high quality games and big names drawing people in?
Definitely. You've got AAA level open world RPGs like Illuvium, where the creatures you capture are valuable NFTs. That boosts immersion and gives a financial stake. And platforms like The Sandbox and Decentraland keep growing, pulling in mainstream partners like Snoop Dogg.
Yeah.
That brings a much wider audience into these virtual worlds.
Okay, fascinating angle with gaming. Let's shift gears again. Stablecoins. These feel different from things like Bitcoin. They're not just for trading anymore, right?
No, not at all. They've quietly become the workhorse of the digital economy. Stablecoins are basically digital tokens pegged to a stable asset, usually the US dollar.
So they don't have that wild volatility.
Exactly. And their use is exploding. The market cap was over $210 billion by the end of last year, 2024. Transaction volumes, $26.1 trillion.
Trillion with a T.
Yep. Now, a lot of that is still facilitating crypto trading, but sources estimate about $1.3 trillion was in what they call genuine payments transactions, real-world use.
Okay, $1.3 trillion is still massive. Where are we seeing these genuine payments happen?
Several key areas. First, cross-border payments. Stablecoins can cut through the high fees and slow settlement times, especially in places like developing nations or the U.S.-Africa corridor. Companies like MoneyGram are using them. BitZo processes maybe 10% of U.S.-Mexico remittances using stablecoins.
That's a real impact. What else?
Corporate treasury and cash management. Big companies' reports mention Ferrari, SpaceX are apparently using stablecoins for things like instant liquidity, fast transfers, 247 availability. It bypasses traditional banking hours.
Interesting. And for everyday businesses.
Merchant acceptance is growing fast. Think e-commerce. Stablecoins can mean lower fees, maybe as low as 1% on-chain, and instant settlement instead of waiting days. You've got PayPal with their PYUSD stablecoin, Shopify, Stripe, even Visa and MasterCard getting involved in stablecoin payments.
So it's really starting to integrate into the payment rails. And you mentioned something about automation with smart contracts. How does that work?
This is where it gets really interesting, especially looking ahead with AI. Stablecoins plus smart contracts allow for programmable money. You can build if-then logic directly into the asset.
Like.
Imagine an AI agent needing to pay for data or a service.
Yeah.
A smart contract could automatically release a stablecoin payment if certain conditions are met, all without human intervention. It enables machine-to-machine commerce, agentic systems. It makes money truly digital and programmable.
Okay, this all sounds incredibly transformative. But we know it's not that simple. There have to be significant challenges, roadblocks to this truly becoming ubiquitous. What are the main hurdles?
Oh, absolutely. It's definitely not all smooth sailing. A big one is just a general lack of clarity. You've got regulatory uncertainty in different places, tons of jargon that confuses people, and frankly, thousands of cryptocurrencies out there. It's overwhelming.
Yeah, the complexity.
And that leads to usability issues. Managing private keys, wallet addresses, it's not intuitive for the average person. Plus, KYC/AML rules, know your customer, anti-money laundering add friction, even though they're necessary.
Right, losing your key is like losing everything. What about the tech itself?
Scalability is still a challenge for some core networks. Ethereum doing 15 transactions per second, Bitcoin maybe 3 to 7. That's just not enough for global mass adoption compared to, say, Visa.
Good point. And security is always a concern.
Huge concern. Scams and hacks are still too common. We saw sources saying 40% of crypto owners aren't confident in security, and nearly 1 in 5 had trouble getting their money out of platforms they used. That shakes confidence.
Definitely. Plus the price swings.
Yep, volatility. Still a major barrier to using crypto like everyday cash. And then there's the lingering criminal association from things like Silk Road or ransomware, even if illicit use is a small percentage now. And of course, the environmental impact of Bitcoin mining is still a valid concern for many.
So a lot of hurdles still. And even with these ETFs making things easier, they're not risk-free either, are they? Are there specific risks tied to these crypto ETFs people should know?
Yes, there are unique structural risks. One is liquidity provider concentration, or LP concentration, and credit risk. Crypto ETFs rely on LPs, but these often have lower credit ratings than the authorized participants in traditional ETFs. Meaning just 3 LPs control over 70% of the market. If one of them has problems, like we saw with FTX collapsing, it could cause major disruptions or even manipulation.
So a few players hold a lot of power. What else?
Custodial concentration risk. This is a big one. Coinbase holds something like 85% of all the Bitcoin owned by these Bitcoin ETFs.
85% with one company.
Yeah. So if Coinbase had a major security breach or went bankrupt or had a serious operational failure, it could be catastrophic for ETF investors. It's a huge single point of failure.
That's worrying.
And finally, even with SEC approval, there are still worries about market manipulation in the underlying crypto spot markets. Things like wash trading, price manipulation, hacking, insider trading. These risks haven't magically disappeared just because there's an ETF wrapper.
Okay, so a lot to consider on the risk side. Given all this, the potential, the growth, but also the challenges and risks, how should people navigate this? How can you, listening now, prepare?
Right. For individuals, the first step is always self-assessment. What's your actual risk tolerance? What are your investment goals? Don't just jump in because of hype.
Good advice.
Then weigh the options. Crypto ETFs offer simplicity, diversification, you don't have to worry about losing keys, and there's professional management. But you pay fees, and you can only trade them during market hours.
And the alternative?
Direct ownership. Buying crypto yourself gives you full control, 24/7 trading. You can participate in things like staking or lending to earn yield. But you are responsible for security, managing wallets, understanding the tech. It requires more effort and knowledge.
So do your homework.
Absolutely. Research thoroughly, understand what you're buying, maybe talk to a financial advisor who actually understands the space. Don't invest more than you can afford to lose. That old adage still holds true, especially here.
And what about for the big financial institutions? Banks, asset managers, what's the takeaway for them?
For them, the message seems to be, This is a massive untapped opportunity. Ignoring it is probably not a good long-term strategy
Why is that?
because their customers want it. Over 60% of crypto owners said they would buy crypto from their main bank if they offered it.
So offer it or risk losing customer?
Pretty much. It could prevent that flight of capital to crypto-native exchanges and actually attract new, younger customers. So things like strategic partnerships, look at JP Morgan getting involved in ETF services or building in-house expertise seem crucial now. They need to adapt.
So as we've kind of unpacked today, this integration of crypto into our economy, into our tech, it's clearly happening step by step. It's an ongoing process fueled by regulation, tech improvements, and just wider acceptance.
It really is. And, while so much debate is about, is Bitcoin a currency or is Ethereum an investment, maybe the biggest impact, the most profound thing, will be how this tech acts as a catalyst
A catalyst for what?
for completely rethinking our global financial system, making it potentially faster, more transparent, maybe more accessible to way more people than the current system allows.
That's a powerful thought. So what new forms of value might emerge as this decentralized future takes shape? And maybe more importantly for everyone listening, how will you participate in its unfolding?
Lots to think about.
Definitely. Thanks for joining us on this deep dive today. We really hope it helped clarify the landscape a bit and maybe sparked some new questions for you. Until next time, keep exploring.